Now, our topic today is on master financial ratio. Last month in our webinar, we talked about how uh, to to see financial statement, master financial statement. In this webinar, we talk about financial ratio. So it's a extension of the webinar last month. And our speaker today is a very credible speaker who has spent a lot of his time into researching companies. He's basically a fundamental value investor. So we'll share with you his criteria in selecting companies, and also what are some ratio he looks at when he go through his KPI with you in selecting companies. So today you will learn about how you can interpret financial ratio and set your own KPI in selecting undervalued companies to invest in. Now the webinar is approximately 90 minutes long, and it consists of two segments. The first segment is 60-minute content by our speaker and followed by 30 minutes Q&A. But the timing is tentative because sometimes you may have overwhelming questions, so the speaker may spend more time to answer the questions. So before we start, of course, we have a disclaimer. So in general, whatever we share with you today is for educational purpose only. So in no way that we give you any recommendation of buy or sell. So whatever that we highlight to you is for case studies. If you decide to buy, you do it at your own risk, because all investment comes with risk. Is that okay? All right, awesome. Now we have a series of webinars lined up for this year under Bursa Malaysia. So over the past 2 months, we have done REITs 101, teaching you how to invest in real estate investment trust. And last month, we talked about master financial statement. This month, we talk about master financial ratio. And next month, we'll talk about introduction to candlestick. And then in July, we talk about how to invest in growth stock. Then subsequent month, we talk about how to invest in cyclical stock, how to invest in value stock, how to invest in turnaround stock, how to identify a sunset stock, and uncover the myth of oil and gas industry. So these are the webinars that we have in store for the entire year of 2017. So if you finish all webinars, I assure you that you will be a good investor. All right. So this series of webinar is brought to you by Bursa Malaysia, and is managed by LifeChamp. So without further ado, let me introduce our speaker today, and he has also spoke on a couple of our webinars previously. And PC is graduated from National University of Singapore in 1989. He has more than 26 years of working experience with several public listed companies, and he's also author of a few books, and he's a full-time investor, author, trainer, and have been investing in international markets and Bursa markets since 1995. So without further ado, let me hand over the floor and the control to our speaker today. Just give me a minute. All right, PC, I'm making you a presenter now.
Okay.
All right, we can see your screen now.
Yep. Okay. Yeah. Good evening, everyone. Thanks for tuning in. So today we talk about mastering financial ratios, where we will look at interpreting and making sense of key financial ratio, understand the EPS, understand the dividend yield, dividend payout, and ex-dividend date, understand and being able to interpret PE ratio, understand net asset per share, and understand net tangible asset. So let's look at common financial ratios. There are a lot of financial ratios that people use to evaluate, okay? But the most common ones are actually current ratio, the gearing ratio, debt to EBITDA ratio, and return on equity. Let's look at current ratio. Now, current ratio is measured by current assets divided by current liabilities. Now, if the ratio is more than 1, it indicates that the company will have no problem in meeting its current commitments. But if the ratio is less than 1, it indicates that the company will have problems meeting its current commitments. Now, current means anything that is going to be achieved inside a 12-month period. So that's what is called current. Anything that is more than 12-month period is considered non-current. Okay, now to bring up the ratio, if let's say the current ratio falls short of 1, okay, the company may undertake the following measures. It needs to improve its business cash flow. so that the amount of cash and equivalent increase and will also increase its current asset. The other thing is to borrow money from financial institution to boost its cash balances. But if a company borrows money from financial institutions here, it will increase financial costs as well. And the other option is to issue new shares if the position is very critical. But this would dilute shareholding and hence reduce share price. Now, sometimes during a financial period of financial turmoil, okay, or economic crisis, a company may find that its current assets will fall short, okay, will be less than its current liabilities. So in such a case, you will see company aggressively issuing new shares because they need to plug the difference between the current asset and the current liabilities. So that is why you see, for example, currently, like in the European Union, they have a lot of banks in trouble. You know, they keep on issuing new shares, and then the share price keep on dropping. So these are the things that can happen. If let's say in the local market, we have companies that are in dire strait, you will see them issuing new shares to boost their cash assets. So gearing ratio. Now this gearing ratio measures the financial leverage of a company. Higher the leverage, higher the risk of investing in a company, and vice versa. What this means is that sometimes company, they will want to borrow money, okay, incurring a long-term liability in terms of borrowings, so that they can use the money to kickstart new investment projects, okay, or they borrow money to improve their cash balances, okay. Now, all these incur costs when the company borrows money. So that's why the gearing ratio is an ideal gauge of a company's financial health. And it is calculated by total liabilities divided by total equity. So if the gearing ratio is more than 1, it means that the company is more at risk. Why? Because when it's more than 1, the major component of a company liabilities actually comes from the non-current liabilities, which is normally the borrowing. Okay, the borrowing cost under the non-current liabilities, okay, is the bulk of the total liabilities most of the time. Okay, so that is why if let's say the ratio is more than 1, okay, it means that the company has borrowed a lot of money, okay, and therefore it is more at risk when, let's say, there's economic shock in the future, because it could also mean that if a higher interest rate environment, the company would also incur higher interest costs. So that's why gearing ratio is a very important gauge to know the financial health of a company. Okay, together with current ratio, you will know pretty complete how a company financial health is. Now, if let's say, okay, it is less than 1, it means that the company is less at risk because their leverage is much lower, and therefore it means that there'll be less risk if, let's say, there's some economic shock in the future. Now, for REITs, you need to remember that the gearing ratio is calculated differently here. It is calculated by total borrowings, short and long-term borrowings divided by total assets. And under the SC regulations, it must not be more than 50% where the gearing is concerned. So debt to EBITDA ratio. Now, a lot of companies, you see, they like to announce EBITDA. Okay, EBITDA is actually earnings before interest, depreciation, tax, and amortization. So some companies, they like to put in their summary the debt to EBITDA ratio, which is the total liabilities divided by the EBITDA. Okay, and this company, this measurement is used to determine a company's ability to pay off its debt load. Now, one thing that you need to know, that any company that operates, normally they would actually have borrowing costs. And borrowing costs incur interest. Then when a company makes capital investment, okay, into plant and equipment, those investments never appreciate in value. They depreciate in value, okay? And a company normally would have to pay taxes if, let's say, they are profitable, okay? And amortization is very seldom costed in unless the company has goodwill, which it needs to amortize it over a certain period of time. Now, very importantly, because the interests are not taken into consideration, depreciation is not taken into consideration, tax and amortization, all these are not taken into consideration. Therefore, your earnings would actually reflect a much bigger value. And therefore, when total liabilities divided by EBITDA, okay, it gives a smaller value in total, okay, because your earnings is a larger pool. Because if you have earnings after interest and all those, your earnings would likely to be smaller, and therefore when total liabilities divided by this will give you a bigger value. So companies who are heavily indebted, sometimes they use the EBITDA to paint a very good picture, okay, and that is actually you need to see beyond that, okay. Now, a negative figure means that the company has not the ability to pay off its debt until the earnings move into positive territory. So this is the most important thing that you need to know, because if earnings is negative, how can the company ever pay off all the total liabilities? Yeah. Okay. If let's say it's positive, then you will roughly know how many times the leverage is. But then, as I mentioned, you never take into consideration the interest, depreciation and such. It gives a very it paints a good picture, but underneath it may be a very bad picture. Now, Warren Buffett is one of the investors who is highly critical of the use of EBITDA metrics in determining a company's financial health. This is what Warren Buffett said. When a company uses EBITDA as a form of metrics to measure, then he asked the question, where does the money come from for the investment, for the borrowing costs and all those? Is it from the tooth fairy? He often say this, which means this money is somehow will be used and consumed. It doesn't just get printed out of thin air. And that is why when companies use EBITDA, don't just look at the EBITDA, go back to looking at the actual current ratio and the gearing ratio, which would give a better picture of the financial health of a company, okay? Because you must know that interest is a product of the borrowing, okay? Because it incur cost. Borrowing have a cost. Investment into plant and equipment will also depreciate over time, okay? So especially if a company is very capital intensive, you will see that they invest a lot in plant and equipment. Therefore, the depreciation will actually be very huge, yeah, over a certain period of time. So if you ignore all this, it gives it paints a good picture, but actually it is not really that.
Mm-hmm.
So
Okay,
yeah.
PC, just now you mentioned about this term called goodwill. Maybe some of us here may not understand what is goodwill. So would you want to share a little bit more?
Okay, when let's say sometimes a company if a company has a very well-known brand, okay, for example, they have certain so-called brand value, okay, that is called a goodwill. So when sometimes a company buys over another company and they bought over their goodwill or their brand value and all those, then it needs to be depreciated. It's called amortization, okay? Because when you buy into something that has a brand value, okay, you need to amortize it because it's a form of investment, okay, which may or may not grow in value in the future, okay? Unlike property, okay, there's always constant, after every 2 or 3 years, companies normally have a valuer to evaluate the current property price so that they can actually put in net changes in fair value of the properties. But if let's say a company buy over a certain product where it has a brand value, it's an investment into that brand value, and therefore they need to depreciate it over time. Okay, so that is normally that's why unless the company buys over a brand, okay, it needs to be amortized. Other than that, if let's say the company have its own goodwill, already its own brand value, it needn't be amortized. Okay, it's only as a form of investing into a certain brand or a certain company that has a certain goodwill. Yeah, clear? So
Yes, yes, yes. We
the
move on.
next one, uh, okay. The other thing we look at is return on equity. Now, this is measured by net profit divided by total equity. This gauge is used to know how much ringgit in net profit is generated for 1 ringgit in equity. Okay, so ROE is sometimes known as return on net worth, but normally the more common one is ROE. Okay, now a high ROE is reflective of a good and dynamic management team in managing their business. Okay, because they are able to deliver a very good and consistent ROE. Now, a low ROE would be the direct opposite. Okay, sometimes, not only you have a low ROE, sometimes you have negative ROE. Okay, when the company, let's say, lose money. Okay, there's no net profit at all. Okay, therefore the ROE can be negative. Okay, because it's based on the net profit. Okay, so to determine whether a company is delivering good or poor ROE, you need to compare it with like companies within the industry. That is why when you do assessment of companies, you compare it of the same peers within the industry. Not like you compare, an ROE for, let's say, consumer product, and then you compare it with the property. Of course, the ROE would be very much different. Okay, so that's why you need to compare it within the same industry so that you know whether this company outshines the rest within the same group peers. Okay, and if let's say the company is able to outshine, then that company has more likelihood in meeting your kind of investment requirement. Okay, when you have compare within the when you compare within the same industry also, and then you compare with other industries. So sometimes you may want to buy a property. Okay, you have a property stock, you have this kind of ROE. Then you look at a consumer, the ROE is maybe higher. Then once you select the best from each sector, then only you are able to narrow down your investment choice, because we don't have so much money to invest in all the good picks. We can only, let's say, out of this industry sector, we find out the best company that meets our requirement, and from another industry, we find the best that meets our requirement. Then we gauge them both together. Okay, should I go for A or should I go for B? Okay, this does not mean that every sector also you should put your money in. So when you have select the best from a particular sector that meets your requirement, then only you compare with another sector. Then that likelihood would actually help you narrow down those companies that meet your investment appetite and also your expectation of returns in the future. So understand the EPS. EPS, as we have talked previously, is earnings per share. It is calculated by net profit divided by the number of shares in circulation. Now, EPS growth is a positive indicator, okay, but you need to confirm this by a similar growth in net profit. Now, I think previously I mentioned some companies, when they buy back their stock, okay, the EPS may show growth, but the net profit actually never show any growth, okay, because the number of shares in circulation has been reduced, and therefore, it tends to inflate the EPS. So that's why looking at the EPS is the most common things that people do. Okay, but then I want to go, normally I go a bit deeper. I want to look at the net profit growth, because if let's say, your profit growth, there's no profit growth, or maybe there is the profit is lesser this year, but then the EPS actually show growth, because why? The company had bought back a lot of shares. So it gives a very different type of picture. But I think to really show a positive indicator, I think there must be a growth in the EPS as well as a net profit growth as well. Okay. Now, So that is why, go and look at the EPS, okay? And if let's say it grows more than the net profit, okay, then but net profit still have a positive growth, then I think it's pretty all right, okay? If let's say EPS, has positive growth, but net profit is stagnant or actually a fall from the previous year, then I think, you need to give more consideration to that particular company and find out other financial ratios, to test its financial strength, okay? So that's why companies sometimes institute share buybacks to effect a greater growth in EPS, okay? Can be beneficial to the share price, but you need to be mindful that the company has the excess cash to do so. Now, sometimes companies may want to get the shareholders to support its plan, okay? So because it wanted to boost the share price, they might borrow money, okay, from the financial institutions, and then use that money to buy back shares because they don't really have that cash at hand to buy back the shares. So what this do to the company is that in order to boost the share price, they actually incur additional debt. So this kind of practice, is what we call financial engineering, okay? You take money, okay, you boost up the share price, okay, and then but it really doesn't have any very net benefit, okay, because share price may increase, but then the debt of a company will actually increase as well. And if let's say there's any shock, then that becomes a burden. So we need to be mindful of that, okay? If let's say the amount that is borrowed is little, okay, did not impact the gearing ratio very much, then you can consider. But if let's say the company is already having a large amount of debt just because they want to boost the share price, okay, they borrow money again to buy back stocks, then that is a very dangerous indicator, okay? It means that that company is not doing well, okay, to boost the share price, but it's being boosted by artificial means, okay, not through the growth in equity, nor in the growth in profit and revenue, okay? So always remember, if buybacks are financed by bank borrowings, then the borrowing cost will increase, and this will result in a higher gearing ratio. Now, understand dividend yield is pretty simple. Dividend yield is measured by total dividend, okay, divided by the share price. Now, normally I would want to compare that if let's say I'm on a long-term investment, okay, and it's very important for me that if the money I put into an investment into any company, its dividend yield must be higher than the FD rate. If let's say I'm not concerned about the dividend yield, but looking at the growth, then it's also okay. So it depends on the nature of your investment expectations. If you are looking at long term, okay, preferably you say I would want to have steady dividend yield as well, then you might as well look at a dividend yield that is above the FD rate, okay? Otherwise, why should you put money into the stock? You might as well put it in the FD. But sometimes people do not look at the dividend yield, but they look at the future potential of a company. And therefore, they may say that dividend yield is not important, but I'm more concerned about the potential of company, which I see tremendous potential, okay? Then it's quite all right. So actually, it depends on your requirement, whether you are the type that wants to look at dividend yield plus long-term growth, or you look at high growth but no dividend yield. Okay, it depends on your own investment expectations. Okay, so sometimes company express the dividend as a payout ratio. Now the payout ratio is calculated as total dividend divided by total earnings. Again, it's very simple. Now, most of the companies, they normally pay about 30% to 50% payout ratio. I think more common is around the 30% range. Okay, but if let's say a company is able to pay out 70%, then it's actually quite a huge dividend payout ratio already. Okay, whatever your choice, okay, each dividend will have an ex-dividend date. If you purchase the share on or after this date, you will not be entitled to the dividend. Now, sometimes people, for example, if you know this is a way to trade REITs. If you know that REITs normally they declare dividend every half yearly and so on, sometimes one of the strategy is to, if that stock is not moving a lot, okay, but you know that there's going to be a dividend date in the future, in the coming future, so you can actually buy it, and then when they announce the dividend, okay, there is going to be some increase in the share price. You can actually sell at that time. Or sometimes people will want to buy it to increase the dividend yield. You wait until the ex-dividend date so that then the share price would drop back. Okay, once they have ex-dividend date, then you can actually buy the share. Okay, so it depends on your strategy of trading it. Okay, now, but in REITs, dividend is known as distribution, and the distribution must be a minimum of 90% of the total net income. So if you are looking for long-term steady dividend type, REITs is actually one of the better choices. Okay. Now, understand the PE ratio. We have talked a lot about the PE and all those, but let's go through it once more. Okay, PE ratio is the price to earning ratio, and it is calculated as share price divided by total earnings. Now, conventional analysis dictates that a company with low PE has better opportunities for its share price to appreciate versus a company that has a high PE. Now, this is not always true. Why? High growth companies in the small to mid cap categories may reflect a higher PE, okay? Because sometimes people notice a potential in those small to mid cap companies, okay? They are looking at the future value, okay? And therefore, you may see some investment already pushing the share price, even though that company may not register, any significant profit growth, okay? But people are already buying into that company for hope that to realize a much bigger value in the future, okay? So that's why if you just look at the use PE as a gauge, then you may miss out some small to mid cap companies that actually have a higher PE, but that has tremendous potential, okay? So how do you know a particular company's PE is over or undervalued? The best thing to do is to compare with the peers in the same industry, okay? So that's why if let's say you can compare within the same industry, you know that, hey, among of those peers in this industry, this company actually have a much lower PE, and I think I'm comfortable in investing, okay, in that company, okay? Then you might then decide, even though its PE is reasonable, then but you see potential, then you can also buy. But if you don't compare within the peers in the industry, okay, like in the small to mid cap, there could be a variety of companies that have PE, okay, that is 15, 20 or so on, okay, which is considered high in a lot of, in many standards, because normally people say that a PE less than 15 is a better gauge to see greater appreciation in the future. Well, it's not really true, okay. Some companies that have potential growth may see PE that is very high. So you, from that category, okay, then you analyze which company actually stand out, and then among those that with the high PEs, okay, the one that meets the assessment in terms of financial ratio, profit growth, and so on, and the lowest PE may be the best choice, okay. So one thing is very important: companies with aggressive share buybacks may have higher EPS and thus a lower PE, although its net profit may fall. So that is why you need to be very careful, okay? Anything that boosts up on the EPS, go back and check against its net profit, whether there is a growth or not, okay? Otherwise, companies just want to boost up the EPS so that, hey, if EPS is huge, the PE ratio would be low, and therefore it makes our share more attractive for people to invest, okay? But a lot of companies go to all sorts of financial engineering to try to position their company as the ideal investment choice, but it's not necessarily true, okay? And there may be certain hidden things. That is why, okay, things like PE ratio, return on equity, and debt to EBITDA, all this you need to go a little bit beyond that, okay, so that you understand cut off all this financial engineering, okay, what are the basics, that meets your requirement. Okay. So understand net asset per share. Okay, the net asset per share is calculated by the total net assets divided by the number of shares in circulation, or total equity divided by number of shares in circulation. Now, for share price to gain, it is important to see gain in net asset per share. Okay, normally when a company is growing, that company having positive revenue growth and positive net profit growth is never enough to allow the company to gain in share price on a more higher frequency. So that's why, you know, companies also need to grow its net asset per share. Okay, so that when people look at it, hey, the total equity actually increased this year versus this year, which means then the company has added value to its equity, not just in terms of profit growth and revenue growth. Okay, and sometimes, okay, a company may have very positive revenue growth and net profit growth, but then it borrows a lot of money, and therefore its total equity is not so good. So that's why, you know, when you look at something that for you to gauge that a company is very well run, okay, to gauge the management expertise, sometimes, you know, if you want to go deeper into research, you can just look back the last 5 years, then you check whether the net asset per share has been steadily climbing. Okay, that could actually reinforce your understanding of the company, and also give you confidence that the management is steering the company into the right direction, because they have been constantly delivering gain in the net asset per share. Okay, of course, during some years of financial turmoil, the net asset per share could actually fall, because companies may have certain write-off or impairment charges. Okay, so if the net asset per share reflects a lower figure, okay, it is an indicator for you to look into some of the things, whether there are any huge write-off or impairment charges in that financial year. Okay, if let's say it is a write-off, read what the management have to say regarding the write-off. Is it a one-time off, or okay, is there an explanation why they need to write off? Okay, or impairment charges and so on. Okay, so sometimes companies invest in certain projects, and that project may suddenly becomes too risky, and that company may exit out of that project. Okay, then you will see write-off and impairment charges, and for that particular year, its net asset value per share could actually deteriorate. Okay,
Can
so
you explain what is impairment charges? Because not a lot of us are, you know, familiar with this term. I think this term is a bit big.
okay, impairment charges are something like they have actually commit a kind of investment, okay, but then that investment suddenly turns sour, but it's not yet, you know, it's not yet gone to a case where it's a total write-off. So that's why they will actually charge a certain charge that's called an impairment charge, so that, for example, the project is originally is 100% of X dollar. Right now, it's worth only 30% of the original 100% invested. Then you have a 70% impairment charges on. Write-off is something, it's like, you know, I'm going to write off this completely because we are not going to gain any value from it. So therefore, the whole lump sum is actually written off. Okay. So impairment has to do has a lot to do with sometimes, especially if they hold inventories. I do not know whether it's let's say company that have inventories, a lot of inventories, but during certain financial crisis, okay, that inventory is not worth so much anymore. So that's why they need to charge it off, and that is a form of impairment charges. Okay, write-off is like, you know, totally gone case already, no hope. Okay, so they need to write the whole thing off. Okay, so this is what normally transpired. Okay, that will impact the net asset per share. Okay, so this kind of thing normally happens, okay, in the aftermath of a cyclical bear market, okay, where like in commodities, if let's say the companies like, let's say in the steel industry, okay, they buy a lot of they manufacture steel. Steel requires iron, okay. They buy a lot of iron, okay, at a much higher cost. But then there's the bear market strike, okay. Iron ore price drop, but then they still have that inventory of iron ore, but which they bought at a higher value. Therefore, they need to charge out that extra, the difference between the current value and the previously bought value, because now the current value is lower than the previous value that they bought. So that's why they need to charge it out as well. That is an impairment charge, okay. So in this regard, okay, when you have all this kind of thing, the share price versus the net asset per share may be high, okay, but it may also indicate that the share may be undervalued pending revaluation of assets in the coming upcycle, okay. So what happened is that if that company already charged out during the next bear market, but then indicators are, okay, let's say about steel companies, okay, indicators are that the whole commodity is coming out of a bear market. Iron ore already gain 10-20%. So you might say that out of the bear market where the iron ore, let's say, price plummet about 50 to 60%, but right now from that bottom is coming out about 10 or 20%. So it could be an indicator, especially if it moves above 20%, which means it's quite certain that it's above, it's coming out of the bear market already. A 10% move or 15% move may be, going sideways, but a 20% normally people would say that, there's strong fundamentals showing that it could be moving up higher than that 20%. So normally, under that kind of circumstances, that company, okay, may not revalue its iron ore because they have already they already have charged it out already. So it's still very low value. But if let's say iron ore continue to trend up, there may be a certain let's say further down the road, another 6 months or 1 year, the iron ore price that they hold may be higher than during the previously amount, which is much lower. Then they may revalue that asset, okay, and this may see that the net asset per share increase back in value. Okay, so that is why sometimes you need to understand the flow of, especially resource-based industry, okay, to do something to do with commodities. These are the things that you need to look out for because they are very affected by a price movement of commodities. Okay, they go in cycles. So just to share my experience, okay, I previously bought some gold mining companies. Okay, at that time I bought their share price versus net asset per share is very high because they have written off billions of dollars. But then I bought that particular company at about 650. I managed to sell it at $19. Okay, that's a gold mining company. But I never let the share price versus the net asset per share as a high value affect my investment because I see that it is coming out of a bear cycle. So these are the things that you look out for, especially if you are looking at steel industries and all those. How do you identify that coming off the cycle and to see whether that company is undervalued or not? Okay. So the other one is net tangible asset. Now, net tangible asset is commonly known as the NTA or book value. It is calculated by total net assets minus total intangible assets minus par value of preference share. So sometimes companies have preference shares. Par value means if the share price par value is $1, they need to times it with the number of preference share and to minus it out. But Malaysia seldom have that so many companies with preference share. Okay, so total intangible assets are things like goodwill and all those. Okay, brand value worth and things like that. Okay, so NTA is only very applicable, okay, when a company is under the subject of a takeover. Because a company that's taking over another company, they would scrutinize its book value, because that company may say that I'm not going to pay, I may pay 30, 50% or maximum, 100% of its book value. But if, let's say, a company is buying, let's say, 2 or 3 times its, let's say, buying 3 times its book value, then that company may be overpaying it. So that's why sometimes analysts, when a company is announcing a takeover, they would normally see whether are they paying good for value money in buying out another company, or are they overpaying? Because if they are overpaying, that company that is buying would see its share price plummet, because they are not getting a good value for money. Okay, so this is normally more applicable in terms of getting the incorporate takeovers. Yeah. Now,
Can you explain the
now we
third
have,
point again, PC? In the absence of
which is
intangible asset and preference shares, total equity
because
is equal to book value.
okay, now intangible assets, for example, a company doesn't have any goodwill. Okay, because goodwill is up to the company to value. Okay, if that company doesn't have any brand value or goodwill which is included in its financial statement, or if, let's say, they do not have preference shares, then that total net assets or total equity then becomes the book value. Okay, so that's why when you want to know the net tangible asset of a company, okay, you need to look at whether it has any intangible assets or preference share. If don't have, okay, if this one is 0, okay, this is also 0, then total net assets becomes your total equity, which becomes your book value. Huh? So putting the information into perspective, okay. Now, I always use a KPI method to measure and analyze companies. Why do I apply a KPI method? Now, every employee in a company, when it comes to whether they are under probation, or when it comes to annual increment, companies normally set KPIs for an employee to make sure that they meet the KPI, so that they can actually grade the employee accordingly and give them a raise. Now, in this regard, you are investing in a company. That company must meet certain underlying KPI, so that it's well worth your money to invest. Otherwise, how are you going to determine that that company is worthwhile and it meets your risk requirement? Therefore, you need to set certain KPI. Now, for me, okay, because right now global economy is not fantastic. Therefore, I have a lower requirement for revenue growth. Okay, and I put it at 5%. It must be more than 5%. But again, this KPI is something that I set for myself. You can also set your own KPI. If you want to become a lot more stricter, okay, in assessing comment, you can say that, well, one of my conditions is that revenue growth must be more than 10%. If it doesn't meet 10%, then it failed in one of my KPIs. So it's up to you to evaluate, but this is based on my own experience, okay, and how I use this for my own benefit to really help me reduce my risk, okay, but then let me identify potentials in certain companies, okay. So net profit growth is 10%. Why is it not 5%? Because company can, company can look at managing its cost, so that despite smaller revenue growth, they can actually deliver better profitability. Okay, so that's why setting this give me an indication whether is the management really good in controlling costs. Because if I put 5% revenue growth and 5% net profit growth, yeah, this grow 5%, that grow 5%, okay, But then I set a higher requirement of 10%, because I want the management to prove themselves, okay, that they are able to, despite a lower revenue, they can still deliver a net profit growth that is higher than revenue growth in terms of percentage. And that is why I use this 10%, okay. Now, current ratio, now there are different types of industries, okay? Current ratio of more than one, I normally use it for capital intensive industry. What is capital intensive industry? Industries that need to apply a lot of capital, okay, in terms of investment into plant and equipment, you know, like property companies, okay, it's very capital intensive. Why? Because they need to buy land to develop, okay, and that's why it's capital intensive. Like shipbuilding, okay, it's also capital intensive, okay. Airline company is also capital intensive because if you don't buy the airplane, okay, you cannot have any, you cannot go to any destination to generate revenue, okay. So this is what I mean by capital intensive. Oil industry is also capital intensive. Why? Because to drill a certain piece of land or a certain block of a sea for exploration, you need to buy up a lease, okay. Then you need to employ, okay, capital to build a rig, okay, for offshore drilling. For example, offshore drilling is not cheap, you know. Some offshore drilling per drill, okay, can cost up to 100 million US dollars, okay, and that is no guarantee, okay, that the drill will be successful to give you that return, okay, in a sense that they discover petroleum, okay. Sometimes they spend, that's why only big companies in the oil industry go for offshore drilling, because it's very, very expensive, okay. A drill offshore can cost as high as 100 million US dollars, okay. So only the big companies, petroleum companies, can afford that, okay. So for current ratio for non-capital industry, okay, is 1.5. Because now non-capital intensive industry are those like in IT, okay. They develop software but don't have a very high capital investment, okay. Like consumer goods, you build a plant and machinery, you invest in plant and machinery in a factory, and it keeps on generating the same consumer goods, and then you can utilize your production time and all those to increase the flow of products or reduce it. So that's why consumer goods, IT-based company, pharmaceuticals, all these are actually non-capital intensive industry, okay, because they sell products more, okay, rather than needing a very high investment into a means to generate the kind of revenue, okay. So for debt to equity ratio for capital intensive industry, okay, is 1. This one is 1.1. Okay, so hold on. Oh, correct. Sorry. Okay, for debt to equity ratio, okay, because they normally for capital intensive industry, a company cannot be buying planes, buying ships, okay, buying land, okay, on cash basis. So they would need to have to take up loans, and that is why the debt to equity ratio, I have a bigger band, okay, for them to fall below, okay, whereas debt to equity ratio for non-capital intensive industry, okay, because they no need to borrow a lot of money, okay. Once they borrow for the plant and equipment, okay, then the rest, the production of the goods, they have cost of sales and all those which can be paid for, okay, through recurring from their suppliers, and then they build their customers, okay. It's very recurring, okay, and that's why the debt to equity ratio is much lower because they no need to borrow a lot of money, okay. Whereas for capital intensive, because they need to borrow a lot of money, and that's why I have a weightage that is I raise it up to 1.5. Now I also use a certain metrics called a payback period, similar like debt to EBITDA, but I just want to understand that if a company borrow a lot of money under is long-term borrowing, okay, how many years it takes to pay off debt using its profit. Okay, this is just a metric that I use very often to gauge. If let's say the company takes 20 years to pay back its long-term borrowings, then it would have failed my KPI, because the longer it takes a company to pay back its long-term borrowings, okay, the longer the period, means the in between, okay, in cycles of economy, sometimes we have 7 to 10 years, and then we have a recession. Now, if let's say the company takes 30 years to pay off its borrowings, yes, the company may have fantastic revenue, fantastic net profit, but then it takes 35 years or 30 years. So inside that period, there are easily 5 cycles of recession. How would the company perform? So that's why I set this benchmark, this metrics myself. Okay, you can use it, or it's up to you whether you want to use it or not. But I'm just sharing with you. This is one of the metrics I use. Okay, so that anything that the company can pay off within a 5-year period, I know that my investment becomes less risky. Because if the long-term borrowings used with the amount of net profit that the company has, it takes 20 years, then likely that company within that 20 years cycle that the company can pay off its loan, okay, the company will be exposed to at least 3 cycles. So each cycle will actually the company may incur a crisis, and either it may have to issue more shares to boost up its capital, okay, or it may be going into receivership, okay, because it has just too much debt. Okay, so this is a metric, simple metrics that I use. Okay, whether you want to use it or not, it's entirely up to you. And if you want to use it, you want to have a stricter requirement, you can put 3 years, or you want to be a bit more flexible, you can put 10 years. Okay, but I already shared with you why I use a 5-year period. Okay, dividend yield must be more than 5.5%. Now, that's the reason why it must be more than 5.5% as my KPI. Currently, dividend, the FD is around 3%. Now, what happened in the financial crisis? The last financial crisis hits, the FD rate, is around 2%. Now, I'm anticipating that if there's a crisis and the company profit is affected, I'm preparing to see a 20% reduction in dividend. Now, if let's say a 20% reduction in dividend, minus 5.5 minus 20%, the dividend yield becomes 4.4%. At least I know that even if under a recession, likelihood, okay, with the dividend taking a hit, the dividend yield will still be higher than an FD yield during a recession. Okay, so in that sense, I know that, hey, if I can park my money long term with this company, because it is still beneficial for me, because despite the recession, it is, its dividend is 100% of the FD rate. Okay, higher. Then this is again a gauge. Okay, now I also use share price versus the net asset per share. Okay, as a benchmark, must be less than 3 times, because I tell myself I'm not going to pay 3 times the net asset per share of a company. So if the value is, let's say, 1.1, 1.2, or even 1.5, I know that there is further potential upside, okay, for me to invest in that company, because it's still below the kind of limit for 3 times. But if let's say the share price per net asset value, the net asset value per share is 2.5, then I may consider that, hey, at 2.5, the upside will be very limited. So I may want to ignore this company and select one that is much lower. So I often use this gauge rather than the PE ratio, because I'm looking at the net asset value. Okay, whether you are going to help me understand whether how much is there a potential upside, because the higher the ratio, okay, means the risk to reward, okay, becomes higher. Okay, of course, when you invest, you want to minimize your risk, and also low risk, high reward. Okay, so looking at the bandwidth of that share, where it falls. Okay, if let's say it's less than 1 time, okay, then it means that that company could be undervalued. Okay, because if let's say it passed all this quite good, and then its share price is around less than 1 time, then it gives me confidence that, hey, there's potential for this company to appreciate in value because no one is actually interested in this company, and therefore its share price remains undervalued. Okay, so PE and ROE, normally I use it to compare versus the peers in the industry. So let's look at the property sector. Okay, now so I use a year-to-date figure based on up to now, okay, of 3 property companies, okay, Diamond, okay, Ecoworld, and Glomac. Now, using the KPI, okay, its revenue, Diamond is 1.4%, Ecoworld is very good, 27.8%, Glomac is 1%. Okay, now why I use rate? Rate is an indicator that it failed to meet the KPI. Now this one is actually minus 1%. Okay, so I use this to actually compare. Okay, net profit growth. Okay, Diamond is 53.6%. This one is 462%. This one is Glomac is 62.1%. Okay, estimated EPS. Okay, now because they have not gone into a full financial year, and normally I use it like if let's say it's the 3rd quarter. Okay, the year-to-date EPS during the 3rd quarter, I divided by 3 and I times 4. It gives me an estimate if conditions remain the same and EPS remains consistent, what would be the full year EPS be? And that's how I work out my estimate, so that from there I can calculate the PE ratio. Okay, so you look at the EPS. Okay, Diamond is projected at 17.34. Ecoworld is 16.63. Glomac is 20.21. Current ratio, okay, all able to meet. Okay, Diamond was very much better position. Okay, debt to equity ratio, Diamond against very low debt to equity ratio. Okay, Ecoworld has the highest, and Glomac is also less than 1. Now, sometimes it doesn't mean that a company with very low debt to equity ratio, okay, is a very good company, because sometimes if a company is too safe, which means they do not know how to leverage, okay, and use that leverage to actually take advantage of opportunities. Okay, so then a company that every time wants to be extra safe may not see its growth potential realized. Okay, so it has its plus and minus. Okay, you have to look at it. What is your risk appetite? Okay, so in this instance, okay, I've set a benchmark of being less than 1.5. All of them able to meet that kind of debt to equity ratio. Estimated payback period, all of them able to meet. Okay, it's all less than 5 years based on their net profit. Okay, dividend, Diamond has. Okay, Ecoworld didn't pay a dividend last year. Okay, Glomac is 0.4 cents. Share price based on that particular date, I think was about 2 weeks ago. Okay, is 2.3, 1.53, and 0.71. So you can see that dividend yield, Diamond actually is 2.2%. Okay, it fails the KPI, but Glomac able to meet the KPI. Okay, net asset value per share. Okay, you have this, so that when I have the share price versus net value per share, okay, you can see that all of them actually is quite reasonably priced with some good potential for upside. Okay, operating cash flow, okay, is 10 million. Ecoworld is negative 36 million, but Glomac is positive 59 million. Okay, so now when we look at, I often look at operating cash flow as more important, although sometimes people say well, you look at operating, but I prefer free cash flow because I know that is really the excess cash. Well, sometimes a company, okay, if you look too much into the free cash flow, it's not wrong. Okay, because you want to see that all these are excess cash that the company earns. But sometimes companies, they need to be making the right investment decision. Okay, for example, if they invest their money, okay, you might not have a positive, you might not have a free cash flow. Okay, but instead they invested into a land or others that is an investment. The money is used for investment purposes. So I often look at operating more important because it shows whether the management, okay, is really able to generate profit from their core operations. Okay, now you have PE at 13.3, 8.5, and 3.5. Okay, estimated ROE 3.2, 11.7, and 12.8. So actually, in terms of return on equity, Ecoworld and Glomac actually is much higher. Okay, Daiman actually is quite low. Okay, so but one thing you need to know, okay, is net profit growth here, although it's impressive, but especially for if you look at the Daiman net profit, it is actually much higher, okay, than 53%, because they actually included one section called fair value in properties adjustment in fair value of properties, which is, you know, a big figure. So that's why, you know, but then fair value adjustment doesn't actually generate real money. Okay, that's why when it comes to properties, normally I minus that out. Okay, because it doesn't give any real money. It's just a valuation to make the statement look good only. Okay, so that's why, you know, for property, I'm a bit more conservative, in a sense that I would ignore those fair value adjustment, because it doesn't generate the real cash to the company. Okay, but it makes the statement look good only. Okay, so these are the things you should consider when you look at the property sector. So this is called the scorecard. So revenue growth, okay, this is a no, yes, no, and then I have this yes, this no. Okay, then the scorecard, Daiman has 6 yes and 2 no, Ecoworld 6 yes and 2 no, okay, Glomac 6 yes and 1 no. Now, on surface, it may see like Daiman and Ecoworld, but if we look back at here, we will then know that, hey, you know, Ecoworld beats Daiman in almost in the net profit, okay, in revenue generated. So
Actually,
these are
Glomac got
important.
7 years leh.
Hold on, 1, 2, 3, 4, 5, 6, 7, 8. Yeah, sorry. Okay, so
Typo.
based on this, yeah, so based on this, okay, I know that, you know, my choice seems to be Glomac, okay, and then I do my analysis. Now, based on the scorecard, Glomac is in, but out is Daiman and Ecoworld. Okay, based on the year-to-date 2017, Glomac highlights are low payback period. Okay, its payback period is lower. Okay, payback period is lower compared to Ecoworld and also Daiman. Okay, low PE. Okay, PE is only 3.5. Okay, and then it's a higher ROE. Okay, 12.8 versus the rest. Okay, and low share price per net asset value. Okay, which is 0.47. Okay, so on this kind of analysis, it looks like Glomac wins. But then, okay, some people may say that, you know, you know, but I think Glomac don't have that kind of future. I prefer Ecoworld. Well, it doesn't mean that if you have done this structure, okay, if you don't like Glomac, you no need to invest in Glomac. But if you want to invest in Ecoworld, then you realize that, hey, Ecoworld still lose out to Glomac. But what are the conditions Ecoworld must fulfill so that I can buy Glomac? In that case, okay, it's okay to consider Ecoworld because of its superior revenue and net profit growth. Because over here, Okay, it really beat the two hands down. Okay, but then due to certain conditions, okay, that it is, you know, it's cash flow from uh, operating. Um, okay, you need to see cash flow from operating. Hold on. Okay. Cash flow, cash flow from operations. Okay. Okay, you need to see its cash flow from operations reverting to positive and a lower debt to equity ratio. So although I have done this analysis, if let's say I remain in favor of Ecoworld, I know that now is not the time to buy as yet because I want to see improvement so that in the scorecard, if let's say its cash flow reverts back to positive, then yes, it can beat Glomac. Okay, because right now the cash flow is negative, and based on the current, the most recent quarterly report, it actually lose out. So I will be saying that, hey, do I? Then you need to make an investment. Do I want to buy now? Okay, or do I want to wait until its cash flow, okay, from operations revert to positive? Then at least the scorecard will look better, and then only I commit a buy. Okay, so then again, I will look for improvement in its debt to equity ratio because for Ecoworld, okay, its debt to equity ratio is rather high. It's the highest, okay, at 1.15. So if this one drop below 1, then it becomes more favorable to that condition. So that is why when you do this kind of analysis, okay, it's really up to you then which one you want to buy, okay. But based on the scorecard, we realize that if I'm not interested in Glomac, whatever I do must actually show something that would beat Glomac. And therefore, if you're not interested to buy Glomac, then if your interest is still Ecoworld, then you wait for conditions of Ecoworld to improve so that it can beat Glomac in the scorecard. And then it would show that, this company would be more in a position to meet your investment criteria. Okay, this is what I mean that by you need to compare with the peers within the industry. Okay, so that when you do so, you limit your risk. Okay, but able to do your own assessment to meet your investment criteria. Okay, now the above is just for illustration purpose only. Okay, to really determine the right company, okay, you need to look at its latest quarterly report.
Yeah.
Okay.
Basically, this is the latest. This is Q1 2017, right? Or this?
Um, Actually, it varies because some are Q3 2017, some are Q2, and the other one is Q1.
How to be
Okay,
Q3
so
2017? We are only at.
yes,
You mean Q3 2016,
so
right? I think
Q3
20.
because they normally comes towards the next the year ending of the financial year. So actually, it depends. I use it the year to date figure. Okay,
Okay.
based on the current. So these are some tips how you want to calculate,
Can
no?
you go back to slide 17?
This one.
Yeah. Actually, you
Yeah.
mean share price over net asset per share is less than 3 times, right?
Yes. Uh,
Is
yeah.
typo there?
This one. Oh, typo.
Yeah, I think
Okay.
slide 16 also there's a typo.
Okay.
Yeah, because
Never mind.
why
I'm
why
going.
I'm- why because I know your approach lah. Because we have been pitching that we have to buy
Okay.
undervalued stocks at a
Yeah.
fair price. So if it's more
Okay.
than 3 times, then it's very expensive. Right? So
Yeah.
what you
Sorry.
mean is
Sorry.
less than 3 times to all.
Less. Yeah. Here.
Yeah,
Yeah.
this is less than three
It's
times.
a
So on
typo.
slide
Yeah.
17, there's a typo that is less than 3 times.
Yeah.
And it's very interesting to see that
Yeah.
Glomac and Daiman actually they are trading below their book value per share. It's incredible.
Yeah.
So cheap.
Yeah. I think it's also because it's also because the people are afraid of the property market because there seems to be a glut in property in certain cities. So that's why people could be shunning investment into property because there's a lot of negative news about properties recently. Okay, and that's why when there's no demand for the share price, of course, then that share price would drop. okay, and then versus its net asset value per share, it will actually show something that is less, okay. So yeah, this one is less, not more. Sometimes because it's a copy kind of thing, okay. So maybe I will amend this later on.
Okay, never mind, we can proceed because we are actually a bit over time already. I think
Yeah.
we come to almost the end already.
So
Yeah.
so if you look at the um, PE, ROE, payback period in different quarters. Okay, so these are the things that you have to have assume that all things being equal, that they will consistently deliver roughly that kind of profit. So that's why all this you can only base on estimation to derive a figure that is consistent for all. Okay, because if you just compare one that is 3/4 versus one that's 1/4, of course, then how do you come with the PE ratio? So that's why you need to look at it. Okay. Now, for example, uh, during the first month, okay, you just times 4. Second month, you times 2. Third month, you times 4, but third quarter is divided by 3. So that's how you reach those kind of assumptions. Now, you cannot, if you want to, because different companies have different financial year. So that's why this is some ways for you to actually even out all the rough edges and you can compare. Okay. So, sorry. I will repeat this all over again because financial statements are important insights into a company's financial health and growth potential. So you have to make full use of them. Okay. So always remember this. Now, questions and answers.
All right. Thank you, PC. We have come to the question and answer session. So on my screen, I see a couple of questions. But before we go to that, let us do something fun, which is we are going to launch a poll. All right. While you are typing your questions, let's launch a poll. Do you see the poll on your screen now? All right, where do you think KLCI will go tomorrow? Is it more than 5 points, down more than 5 points, or trade within 10 points of today's close? All right, so let us have some opinion here. In the meantime, you can type your questions. PC, I will take back the control. Is that
Yeah.
okay?
Okay. Meanwhile, I'll make some amendments.
All right, we have 72% people voted. All right, 80% of people voted. Okay, let's close the poll and share our results. All right, so this is the result that we got. 44% of you think that it will be up more than 5 points tomorrow. 11% of you think that it will be down more than 5 points tomorrow. Well, 45% of you think that it will go sideways. All right, so well, it's interesting to see that a lot of you are either bullish or go sideways. All right, cool. So let's hide the results. And now let us see how many questions we have. All right, before that, let me go to my slide. All right. Well, hang on, yeah. I forgot to share my screen. Okay. Can you see my screen now? All right, awesome. Now, first question is which financial ratio got the least manipulation or the least financial engineering to picture it nicely to investor? Very
I
interesting
think
question.
always fall back to the current ratio and debt to equity ratio because anything that is EBITDA should be avoided totally. Okay, so whatever you see that sometimes people like to put net debt to EBITDA or debt to EBITDA, anything to EBITDA you should totally ignore it because it doesn't give you the right picture. Okay.
Okay, next question is, may I know what is the benefit of giving dividend since the share price will adjust itself accordingly after the X date?
Well, sometimes, although it may be adjusted, but if you look at it, one particular company that in fact, those of you who follow me last year when I did an analysis on Dialog, Dialog, they have been paying dividend, okay, for many years, okay. But then if you look at one of their corporate analysis, they actually come out, they actually are growing annually, 33% annually. So it doesn't mean that paying a dividend, the share price wouldn't appreciate. But giving a dividend, at least let the long-term holders know that they are able to earn income, okay, while holding onto the share. That's why company often would reward holders with dividend. Okay, some companies never pay dividend, okay, but then its share price can still appreciate because it still continue to hold a lot of cash. Actually, it depends on the company's management, whether they want to see basically share price appreciation only, or they want to reward shareholders. Sometimes when they reward shareholders, then it creates a demand for that share, okay, because people want to earn dividend, okay.
Okay, thanks, PC. The next question is, on slide 16, where to find payback period information? Where is it usually stated?
Payback period, normally I use it from under the non-current liabilities. Okay, you can look at it under the non-current liabilities. There's one item called borrowings. Okay, now that is called the long-term borrowings, and I often use that as an important gauge. You can look it under the non-current liabilities.
Okay, awesome. Now, next question is how to determine whether it is well, sorry, I need to rephrase the question because it's grammatically a bit off. So, how to determine whether the share price is under book value?
Well, like normally I would use it as a share price per net asset value per share. It's much easier. Okay, so I wouldn't use book value direct, because sometimes the book value, like I say, it have a preference share. Then you need to do a lot of minusing. If that intangible asset, you also need to minus out. So, but if net asset value per share is very simple, because the net asset, you just divided by the number of share, you get it already. So the share price versus that will at least give you a rough indication. Okay.
Okay, but the question is how to determine whether the share is under book value.
You
Actually,
divide the share price
yeah,
by the net asset value per share lah.
yeah.
Then if let's say it's 1, which means the share price is equal to its book value. If
Yeah.
less than 1, it is less than that.
So the answer to that question is you need to find out what is the share price now, and you need to go to the balance sheet and see what is the book value, and then you do a comparison. Okay.
The net
Yeah.
asset value per share
Correct.
lor.
To answer that question, yeah, I just add on. So next question is, uh, hang on, yeah. Sorry, he asked a repeat question, so it's the same question. So I just screen out. Among all the available stocks on Bursa, how do we pick the stocks for analysis? That was a very interesting question.
Okay. Now, it's very difficult for you, okay, to analyze individual stock. So that's why what is important is to understand economic trend. Okay. I always adopt a top-down approach, which means what are the fundamentals of the economy currently. Now, for example, if let's say back when the US dollar to ringgit is very strong, then I would actually search out, okay, manufacturing companies that actually do export-based business, okay, and their export-based business is a huge chunk of their business rather than locally. And then if I know that, then I would look at what are those manufacturers that actually do a lot of export. Now, one of the major ones, I think the most favorite among others, is actually look at the glove manufacturers, okay, the rubber glove manufacturers, okay. Those actually earn a lot of, in terms of ringgit terms, because US dollar was actually appreciating then. So you look at the economic conditions for you to determine which sector. Okay, for example, right now there's a lot of negative news about property and all those. You see a lot of people not buying property stocks. That's why property stocks, their share price versus the net asset value per share actually dropped, because people are afraid, there's a glut, and then the share price would not have potential to appreciate. then if you are, it might be a time now to collect some because the share price versus the net asset value is so low. Okay, so these are the things that you should look out for. And if you feel that its time is not right yet, then you see whether there's further fall in the share price, and then the share price to net asset value will be much lower, and then only you move into the property stock. So at the end of the day, is understand the economic fundamental first. Then you will know which sector to actually look into.
Yeah, good answer. So in follow up to the net tangible asset just now, so this is one question that whether should we compare NTA on quarterly basis or on a monthly basis?
Okay, I think most importantly, if you are looking net tangible asset, I don't look too much into the net tangible asset, but I look more into the net asset value per share, which is the total equity. Okay, for me, the total equity is more important. Okay, for a company to grow it, and to grow it, okay, I will look at it on an annualized basis, because sometimes in a quarter it may go up, it may go down, but if the whole year, then you would know which direction the company is going. That's why sometimes if you want to look at the total equity, you need to go for the trend of a company over a certain number of years. Then you will know that it's growing its equity. Then that gives you confidence in that the capability of the management, and their objective is to grow the equity, because by growing the equity plus increase in revenue and profit, can the share price appreciate. Okay, if equity doesn't grow, then the share price will be pretty stagnant. Okay, because there's no matter what, the value is like that. Okay, only sometimes you have marginal increase or decrease because of revenue growth and profit growth. But normally, if profit growth does increase, your total equity should increase, because your current asset actually improve because your cash and balances increase. Okay, so look at that on a total equity. You have to look at it on an annualized basis.
Okay, next question is which financial statement to look for free cash flow? What is the difference between free cash flow and operating cash flow?
Okay, now operating cash flow are what the company gains from operating a business. So normally the cash flow statement, like last time we look at it, there are three sections. One is operating cash flow, one is actually financing cash flow, the other one is investment cash flow. Now, if all added together, okay, minus the investment, okay, and that's a positive figure, okay, then that is a free cash flow. Okay, so a lot normally it's the investment part that actually takes up a huge chunk of it. Okay, and sometimes the financial activities also, if the company decides to pay off a large amount of loan, okay, then the cash flow could actually be reduced, and therefore your free cash flow could also be reduced. Unless if the company borrow money, okay, then it's free cash flow. The total cash flow can actually be expanded. Okay, so it actually depends on the financing activities, investment activities, as well as the operating activities. But I prefer to look at the operating activities.
Okay, awesome. So in other words, free cash flow is just operation cash flow minus the capex.
Yeah.
So next question um, is this ratio suitable for ETF evaluation?
I think ETF is a total evaluation altogether, because ETF normally you need to look at the net asset value, okay, as an indicator, because the ETF price would trade very closely to the net asset value.
All right, awesome. Yeah. So considering REITs, YTL REITs currently has the highest dividend payout ratio. Would you recommend YTL REITs?
If let's
Well,
say you
disclaimer, we don't recommend any stock one, okay? BC, you may
yeah,
continue.
yeah, if let's say you look at YTL, okay, uh, I did a study on YTL about 2 years back. One of the things then was that it really, they actually invested a lot of money into the overseas assets in Japan as well as in Australia. So they started to increase their units because to fund that kind of asset purchase. So the units were increased a lot, and therefore the share price dropped. Okay, and that's why sometimes when the share price drop, but the dividend yield is let's say the amount of dividend remains stagnant, but the price of the unit drop, therefore it tends to reflect a higher yield. So that's why when you look at REITs, you need to look at its gearing ratio. Okay, you need to look at whether there's a net income growth or not. Okay, if let's say the net income growth is not there, okay, but the dividend is stagnant, but the unit price drop. Therefore, it will give you the feeling that its yield is the highest. Okay. Very importantly, risk is not just to look at the yield only, but also there is a trend that there is both revenue growth as well as net income growth from the rental, and then that will give you a better gauge.
All right. Thank you, PC. We we are almost at 10 o'clock, but we still have a lot of questions. So if you still have questions, please, don't have time for that already, so you don't have to ask anymore. But we will still go on with our existing questions now. So just now there's a follow-up question: is the 90% payout for the REITs will remain the same in the future?
So far under the SC rules, okay, it remains it is 90% the minimum. So some actually pay out more than 90%. Okay, so unless the SC change the rules, otherwise, it should remain the same.
Okay, awesome. So what does negative operating cash flow actually mean for Ecoworld? There's one question.
Which means that its operating activities did not generate any positive cash flow, mainly because they if let's say they done a lot of there could be a lot of depreciation, or it could be a lot of work done. Okay, but then the profit is much lower because they have not built. Okay, so when you look at property companies, it's not that sometimes they have certain quarter that actually have very high revenue and very high profit. Sometimes they have a lot of investment, and therefore there's a lot of depreciation. Okay,
Yeah, but depreciation should be added back to the operation cash flow.
yeah, sorry.
Yeah.
I have to relook at it. Okay,
Yeah.
But most importantly is that I think cost will be so unless that kind of profit, I think at the end is the profit lah. The underlying profit.
So let me take the question. Actually, negative operation cash flow is actually not very healthy sign, because it means that from the business, in operation business, right, they are actually losing money. Yeah. That's it. Okay.
I think, because I think the operating cash flow, you add back the expenses as well, isn't it?
Yeah, you got the expense, you have to add back the non-cash expenses like amortization, depreciations. Yeah, these are the things. Yeah. So anyway, let's move on. So what's the meaning for? What's the meaning? Oh, I think he's asking about what's the meaning for net NTA and the correlation with share price. I think we have just explained that. So we talk about book value, share price versus a net asset per share.
Yeah.
So
try not to look at NTA lah.
Okay, yeah. So we have answered that already. So we'll move on. So PC, you taught us about doing investment based on metrics KPI. However, how do we consider the market sentiment?
I think the now market sentiment would actually dictate the share price. Correct? Now, if let's say market sentiment affect the share price, okay, then that is certain metrics like share price over the net asset per share, okay, would give you an indication whether is it undervalued, okay, or if the share price is low, the dividend yield seems to be high. So then, this will actually have some measurement of the sentiment, and sentiment would also be translated back to the company's revenue growth or revenue growth and profit growth as well. Okay, although in the balance sheet it doesn't make a lot of difference because that is under the purview of the management, but sentiment would dictate the revenue growth, would dictate the profit growth, would dictate the dividend yield because it's related to the share price as well as the share price per net asset value. Okay, so that would give you some indication of the sentiment.
Okay. What is preference shares? Next question is, yep.
Um, okay, I'll try to. Preference shares are those that are shares that actually rank higher than the normal shares, the ordinary shares. Okay, which means they are preference shares also pay a fixed dividend. Okay, so preference shares are sometimes you can say it's like a marriage between a share and a bond. Okay, because people who buy preference shares are actually injecting capital into a company and they are paid a fixed interest rate. Okay, regardless how the company is doing. Okay, even the company lose money, but if let's say they have preference shareholders that are entitled to X% of dividend per year, the company still have to pay. Whereas ordinary shares is like, if let's say the company makes money, then they may pay dividend. If the company doesn't make money, they will not pay any dividend. But preference shares, whether the company makes or lose money, they still have to pay that fixed percent.
Okay. And to add on, in the event of a bankruptcy, the preference share will get a claim first lah.
Yeah,
After the
they rank higher
bondholder
than
get a claim.
ordinary
And
share.
one more thing about preference share is preference shareholders has no voting rights
Yes,
in
yes.
AGM. Anyway, let's move on. So this gentleman is asking a stock, a particular stock. Is D next mother share and is warrant overpriced? D
I
and
think I will
EX.
not.
Yeah.
Okay, I don't do
Are you studying that?
analysis of all
Yeah.
types of stocks, and
Yeah.
so I can't answer. I'm sorry.
Yeah. So
Okay,
actually,
whether it's overvalued or not, yeah.
yeah, DNext is one of the hottest stock lately lah. But anyway, because our speaker did not cover that share, so we'll just move on. Next question is, um, can you repeat the payout ratio range? Which one is better? If more than 100% mean better or the opposite? Oh yeah, yeah.
Okay.
Okay.
Uh, Now
Please take it.
this is a very good question, yeah, because payout ratio should not be more than 100%. Okay, because a company cannot be paying more than it is earning. If let's say a company is paying more than it's earning, you have to ask yourself, where is the extra money going to come from? Now, most likely it's going to come from borrowing money.
And it could be
Okay.
retained
Now,
earnings ah.
well, it could be, but normally I would look at it. If let's say the company, but luckily in Malaysia we don't have so much of all this hanky panky. But in US, what they do, they borrow money to buy back stocks, okay, and they also borrow money to pay dividend, okay. But in Malaysia, luckily we don't have so much of all this hanky panky, so much financial engineering. But sometimes you have to ask yourself, if the company is paying more than its earning, then you have to look at it. Number one, okay, unless the company has a very huge cash balance, okay, then it may, like you said, retain profit. Then if they have a very large cash balances, okay, then they want to give more than what is earning to the shop, then it's fine because the cash balance is up. Most of the case is that if a company is not earning as much, but they are paying more, go back to the amount of cash and equivalent balances. Okay, if let's say it's not a lot, most likely they have to borrow already, and that is something that will raise a red flag. No?
Okay. Um, okay, PC will go faster. With e-commerce businesses flourishing, would you say that in a broad sense, logistics industries are to have uh, to be focused on?
Yes, I think if let's say e-commerce is gaining traction, yeah, it could be something that's worthwhile to look into, because um, the dynamic of the e-commerce is moving very fast. Previously, it's just through means of credit card. I do not know whether there could be a time when it will go into cryptocurrency, and that would actually encourage the development of e-commerce even more.
Okay. Next question is there any website that analyze all the financial ratio without us having to do the calculation?
I I there are some but I think I will not name them. You can actually go do a Google search. Okay, that there are some websites that actually do analysis. Okay, I do not want to show any favoritism lah. Okay.
Okay. Um, yeah, next is a very good question. As we know that currently 2017 is meeting a 10 years financial cycle, I worry about the Fed increasing the interest rate will affect the benchmark of setting the interest rate from national bank, which will increase the default in the market. Do we need to be careful when we decide to join the stock market, especially those property sector? Now, PC, please make
Mhm.
your reply short.
Okay. Okay. Whatever it is, look at the development in the US. Now, whatever the US does, it will spread over all the world. If let's say Auntie Yellen decided to raise interest rate, then most likely it will impact the rest of the world as well. Okay, to a certain extent. But you need to be very careful. Sometimes when the cycle is poor in the US, like what happened in 2008, there will be an influx of foreign funds into emerging markets. Okay, so you have to watch what's developing in the US to really have a gauge of the movement of interest rate.
Okay, the next question is how accurate is the company information provided in Bursa Marketplace platform?
I think all directors and all those, they are liable to be fined or go to jail if they abuse their position. Okay, you have to rely on that they will do due diligence. Okay, of course there may be some cases where they will over declare income or also whatsoever. There has been cases previously. That's why you need to be that's why you need to look at the company's trend. Okay, what is by using certain KPI to gauge the company whether they meet your kind of risk assessment or not.
Okay, so the next question is risk trend is REITs real estate investment trust trending on hike until Q4 2017? Any comment?
Trending on
Trending on hike until that means I think what
is
I
it
understand from this question is risk
high
going
interest rate?
higher or not? Is on uptrend or not until Q4
Okay,
2017?
I think the REITs, for example, I think those more stable ones now. Okay, are those if you are looking at shopping mall REITs, like I always say, the only shopping mall REIT that you can really bank on is very difficult to find car park. Okay, then you know that they have a lot of traffic. Okay, but the others that you can look at is maybe healthcare may be stable because there's always demand for healthcare. Okay, but shopping rate you only go to those that very difficult to find car park. Not really a lot actually. There's a few that you can select.
Okay, which financial ratio show the best margin of safety when we decide to buy a stock?
If you are looking at financial strength, very importantly, from my own gauge, the company must have the financial means to survive a crisis, and that is when I look at debt to equity ratio and current ratio because short term is able to meet because normally in an economic crisis it can last 2 or 3 years. So that's why the debt to equity ratio is important to test the strength of a company. But if let's say the company doesn't even have revenue growth or net profit growth, eventually it will also deplete its balance sheet, you see. So it must have a combination of various, okay.
Okay, last question. If election happen this year, will the KLSE index continue to surge or not?
That one need a crystal ball. Quite difficult to say lah, okay.
You see who wins lah. Usually,
Yeah,
is if the incumbent government wins, then the KLCI should continue its uptrend.
people investors look for stability lah, put it that
Yeah,
way, okay.
if
But
the
it's hard
opposition
to pin.
wins, then usually the stock market will tank lah. Mm-hmm.
uh,
Correct or not? Anyway,
well,
yeah,
need a crystal ball lah.
yeah. We don't want to go to politics, but usually it's like that lah. When the incumbent ruling party wins, then usually the stock market will be stable lah. If opposition wins
People
because
always
it
look for
bring more
stability.
uncertainty. Yeah.
Yeah, they will always look for stability.
Okay. So anyway, we come to the end of the Q&A. We exceeded the time for a little bit for 10 over minutes, but it is all right. So next webinar, we will cover introduction to candlesticks. So for those of you who want to understand how to read candlestick patterns, you must join this webinar because I will personally conduct the webinar. All right. So the date is 6th of June, Tuesday. time from 8:30 to 10 o'clock. Registrations link has been sent through chat, so please check that. All right, so want to thank PC for spending your time with us to share with us how do you interpret financial ratio. And I believe all of us here have learned a great deal from you. And moving forward, we'll be more careful when it comes to using financial ratio and when think about earning before interest and tax and so on, and looking at PE and share buyback and stuff. So with that, I want to thank everybody for paying your attention in this webinar. For those of you who have been asking about recording for webinar 1 and webinar 2, please stay on in this webinar. I will send you shortly. Please don't leave it because I will post the webinar 1 and 2 recording link in the chat shortly. Just give me 30 seconds. Let me go find and then I will post it there. All right. With that, thank you everybody, and have a pleasant rest of the day.
Okay. Thank you everyone for tuning in. Okay, and thank you, Chun Sen, for doing the whole thing for everyone. Goodbye. Good
All
night.
right. Goodbye.